Well, as I say, the breaking news of the night is that Donald Trump's illegal tariffs are gone.
The three-judge panel in New York has effectively balked almost all of Trump's disastrous tariffs.
The federal court has just blocked the bulk of President Trump's sweeping global tariffs from going into effect.
By late May 2025, a ruling from the U.S. Court of International Trade sent a jolt through corporate America. If upheld, the federal government could be legally obligated to return tens of billions of dollars in tariffs, along with accrued interest to thousands of U.S. companies impacted by the Trump administration's Liberation Day trade policy. For businesses that had already absorbed steep import duties, many of which had restructured their supply chains or raised prices to cope with the financial pressure, the decision opened the door to financial relief. But it also introduced a new wave of instability. The economic aftershocks weren't theoretical, they were already unfolding. Firms across manufacturing, automotive, and consumer goods began filing claims for reimbursement. At the same time, capital investment plans across the U.S. began to stall. For many companies, the uncertainty wasn't just about the tariffs themselves, but about what came next. Would the tariffs be reinstated? Would a future administration reverse course again? And how could any long-term investment strategy be justified in such a volatile policy environment? Several major manufacturers responded swiftly. In Texas, a well-known appliance manufacturer announced a pause on its planned factory expansion, a $200 million project that had been scheduled to break ground in July. When asked why, a company executive responded bluntly, "We don't know what the law will say next month. How can anyone justify sinking hundreds of millions of dollars into expansion when the economic rules keep shifting beneath our feet?" Across the country, similar scenes were playing out. Supply chains that had been re-engineered to avoid tariffs were now hanging in limbo, unsure whether to maintain costly workarounds or revert back to pre-2023 models. Strategic decisions around sourcing, logistics, and pricing, all dependent on tariff stability, were being deferred. For global businesses, the U.S. had suddenly become a riskier, less predictable player in the trade landscape. This wasn't just a court decision, it was a rupture in economic confidence. And the cost wasn't only measured in dollars refunded, it was measured in projects paused, opportunities lost, and a growing sense that policy risk was becoming just as important as market risk in corporate boardrooms. On May 29, 2025, a landmark decision from the U.S. Court of International Trade in Manhattan fundamentally altered the trajectory of America's trade policy. The court ruled that President Donald Trump's so-called Liberation Day tariffs, a sweeping set of import duties imposed earlier in the year, were in direct violation of the International Emergency Economic Powers Act, IEEPA, a federal law passed in 1977 that governs the president's authority to regulate commerce in times of national emergency. In its decision, the court made clear that Trump had overstepped the legal bounds of the IEEPA, which only allows the executive branch to impose economic restrictions if it can demonstrate an unusual and extraordinary threat to national security arising from abroad. The administration had argued that the U.S. trade deficit and the fentanyl crisis constituted such threats. However, the court rejected this rationale outright, stating that neither issue met the legal threshold, and more importantly, that the tariffs in question did not directly address or alleviate those conditions. As a result of the ruling, the administration was given 10 days to begin dismantling the tariffs, unless it successfully obtained a stay pending appeal. In legal and economic terms, this marked one of the most significant rollbacks of unilateral trade policy in recent American history. For a presidency that had positioned tariffs as a core instrument of leverage economically and diplomatically, this was a strategic setback with wide-ranging implications. The court's decision effectively drew a red line around the use of emergency powers to reshape global trade. While previous administrations had flirted with the limits of executive authority in economic matters, this ruling established a judicial precedent that policy decisions with massive economic consequences must be grounded in verifiable, immediate threats, not vague or politically convenient interpretations of national emergency. Importantly, this wasn't just a legal rebuke, it had direct economic consequences. Overnight, it cast doubt over dozens of pending trade actions, unsettled expectations in financial markets, and forced companies and investors to reassess the reliability of U.S. policy enforcement. With one ruling, the court had not only halted a tariff regime, it had inserted a new level of uncertainty into how and whether U.S. presidents could act unilaterally on trade moving forward. In the wake of the court's decision to invalidate the Liberation Day tariffs, companies across multiple sectors found themselves in a strategic vacuum. Many had already made costly long-term decisions to adapt to the new tariff environment, relocating manufacturing operations, restructuring supplier contracts, and overhauling logistics networks to reduce exposure to taxed imports. But now with the tariffs suddenly removed or suspended, those decisions appeared not only premature but potentially wasteful. Factories that had been opened in Vietnam, India, or Mexico to bypass Chinese or European goods subject to tariffs were suddenly no longer necessary, or at least not economically optimal. Likewise, investments in domestic production in states like Ohio or Michigan were thrown into question as firms reconsidered whether reshoring still made financial sense without protective duties in place. The most damaging consequence, however, wasn't just sunk costs. It was a collapse in strategic clarity. In the absence of a consistent and enforceable trade policy, business leaders found themselves unwilling to commit to expansion or retooling. A senior executive at a mid-sized electronics firm summarized the sentiment bluntly. "It's not the tariffs themselves that are killing us, it's not knowing whether they'll exist next quarter." As a result, capital expenditure plans were delayed, hiring slowed, and confidence in U.S. policy as a planning framework diminished. Domestic production initiatives, which had been slowly building momentum under the promise of protectionist policies, began to stall in real time, not because of market forces, but because of legal and regulatory unpredictability. At the same time, the court's decision opened the floodgates to a second economic challenge: the sheer scale of tariff refunds now legally owed. Importers across the country began filing for reimbursement of duties paid under the now invalidated tariffs. And these were not isolated claims. They spanned everything from automotive components to consumer electronics to food and beverage imports. Each refund request also included statutory interest, meaning the federal government was potentially liable for billions of dollars in repayments at a time when fiscal pressures from debt servicing and entitlement spending were already mounting. This sudden and unbudgeted liability introduced a new layer of stress to the federal budget. One particularly high-profile case came from a New York-based wine importer who had paid significant duties on shipments from France and Italy under the Liberation Day regime. After the ruling, the company filed suit for full reimbursement, plus interest citing direct business losses caused by artificial price inflation. This kind of legal response was expected to multiply across industries, turning what had been framed as a bold political move into a costly economic reversal. And for federal agencies tasked with processing claims, adjudicating disputes, and allocating funds, the ruling meant a surge of administrative and financial burdens, all under a tight legal timetable. Just as global supply chains were beginning to recover from the multi-year dislocations caused by the COVID-19 pandemic, the sudden reversal of U.S. tariff policy shattered the fragile momentum that had slowly begun to build. Industries that had spent years recalibrating sourcing logistics and pricing in response to geopolitical tensions now faced a new and equally destabilizing force: legal and regulatory whiplash. Sectors like steel, aluminum, electric vehicles, EVs, and household appliances were among the hardest hit. These industries had benefited, at least in planning terms, from predictable tariff protections that encouraged onshoring and long-term capital investment. But the court's ruling eliminated those buffers almost overnight. Now, without the price shield that tariffs had provided, American-made goods were once again exposed to intense international price competition, particularly from low-cost producers in Asia and Eastern Europe. This placed many domestic manufacturers in an impossible bind. On one hand, the lack of protective tariffs made further investment in U.S.-based production financially unattractive. On the other, the absence of long-term policy stability made returning to global sourcing just as risky. The result was a paralysis of decision-making, particularly for mid-sized companies that lacked the scale and flexibility to absorb volatility. The Trump administration's overarching goal, widely stated across speeches and policy briefs, was to revitalize American manufacturing by bringing production back home. For a time, the use of tariffs as a strategic lever had appeared to be delivering on that vision. At least partially, companies began exploring domestic factories, states lobbied for investment, and reshoring initiatives gained political traction. But with the invalidation of key tariff powers, that momentum quickly faded. Rather than stimulating U.S. industry, the sudden reversal left projects in limbo and hollowed out the confidence required for long-term planning. Investors, both domestic and foreign, saw a cautionary tale in the American approach: high-stakes industrial shifts made vulnerable to legal challenge, partisan change, and administrative inconsistency. Perhaps more damaging still was the erosion of trust among foreign trade partners. For allies like the European Union, Japan, and Canada, the U.S. appeared increasingly unpredictable, not only in its willingness to impose tariffs, but in its capacity to uphold them. As a result, negotiations stalled, trust weakened, and diversification away from the U.S. became a rational business strategy for many multinational firms. Instead of reinforcing America's position as a stable manufacturing hub, the policy reversal did the opposite. It highlighted the fragility of industrial planning when dependent on volatile executive actions, and it exposed systemic gaps in how the U.S. aligns trade law and industry strategy. In the end, the most profound consequence of the court's decision wasn't financial, it was psychological. The ruling exposed a deeper vulnerability in the U.S. economic system, a reliance on reactive policymaking without legal grounding or long-term strategic coherence. The Liberation Day tariffs didn't just fall, they collapsed under the weight of their own legal fragility. And in doing so, they took with them the credibility of a national industrial policy that was already under strain. The core lesson for both policymakers and the private sector is this business doesn't fear tariffs as much as it fears uncertainty. Companies can, and often do, adapt to higher costs, rerouted logistics, or even trade barriers. But they cannot operate efficiently in a system where policy can be reversed with a gavel stroke, where rules shift with every administration, and where billion-dollar strategies are contingent on a court's interpretation of a decades-old statute. This wasn't merely a legal defeat for one administration, it was a strategic failure for the entire U.S. trade and industrial planning apparatus. The disconnect between aggressive executive action and judicial oversight revealed just how fragile the system had become. Instead of catalyzing industrial revival, the tariff regime's collapse amplified market hesitation, disoriented corporate strategy, and diminished America's reliability as a trade partner. And so the story ends where it began. Not in Washington, D.C. or inside a courtroom, but on the ground in ports, factories, and boardrooms where the real economy unfolds. As companies reroute shipments, delay investments, or look elsewhere for regulatory consistency, the U.S. loses not only economic leverage, but institutional trust.